Welcome to the Tesla Economist. Please hit the thumbs up and remember to subscribe. You can follow me on Twitter and talk to me on Patreon. Okay, exciting. As you all likely know by now, Tesla beat all the estimates with an EPS of $3.22. They even beat mine. So let's find out what they've done. Well, we have $3.6 billion in operating income, which is about 10% higher than I estimated. I pretty much had the highest estimate out there, and Tesla still beat mine by this much, resulting in over 19% operating margin. This is a net income of $3.3 billion, which is huge. A lot of this was attributable to a 32.9% gross margin. I almost wanted to place 32% in for my margins, but I thought there were too many supply chain issues and potential price rises. But perhaps this is a sign that Tesla has locked in their prices and are not so susceptible to all the price rises. This margin is insane though. It's incredible actually, as a lot of this could be due to how profitable Shanghai is. Now they're using more CATL LFP batteries and ramping up better. But wow, remember, we were probably down 15,000 deliveries for this quarter compared to Q4, what with Shanghai shutdowns and a shorter quarter. So bear that in mind. This quarter is outstanding. My vehicle revenue estimate was only $200 million lower than the actual figure, which means I was really close with the average selling prices. But credits. We got $679 million in credits. That's huge, and is responsible for this increased EPS. I mean, this is more than twice what I predicted, and I'm sure most likely everyone else too. I don't think anyone was expecting this. Remember, credits are 100% gross profit and are included into the actual margins of the vehicles. I'm afraid the actual gross margin when you remove credits is only 30% on the vehicles. But if we include the tax credits that I estimated, then it would come in at 31% gross margin, which is very close to my guess. In other words, a lot of this margin is coming from the credits. But remember, these margins do not include all the recent price rises. When these come into effect, we should see some really good margins. However, at that stage, they'll be diluted by all the other lower margins from the new factories. R&D is at the highest I've ever seen it, presumably further investment in FSD as we're hopefully getting close. It could also be more investment in the dedicated robotaxi, or possibly the bot. Selling general and admin back to normal levels. I'm not sure Wall Street realized last quarter had some major one-off expenses. This may increase somewhat next quarter with the new factories coming online full time as well. Tesla say they plan to continue a 50% average annual growth in vehicles over a multi-year horizon. To give you an idea of what 50% growth is, if we start at 1.6 million this year and it continues for 5 years, i.e. by 2027, then we'll be at 12 million vehicles a year. That would be a good trajectory. All of this will result in a much lower PE ratio for Tesla too. We'll go over this in more detail later. I think my financial estimates were really on the money this quarter. I had a good feeling about it. The only surprise was the tax credits at an astonishing almost $700 million, which would have caught everyone out. There isn't really anything that amazing to see here otherwise, but the numbers do look good where they matter. So let's hope the earnings call is good too. Thanks for listening. Please hit the thumbs up and subscribe. You can follow me on Twitter and talk to me on Patreon.